Hi, I'm Patu from freefincal. Today, let's take a look at some data which will show you why a simple SIP in a small cap mutual fund is a waste of time and money. These small cap funds came into the limelight uh, during 2014, and then later on, a couple of years later, when the stock market started moving up, and people started looking at their past returns, the returns that it gave in 2014, the returns that it gave in 2017, I think, 17 or is it 16? I forgot. Couple of years later and so on. There are 16, yeah, and after 2016, there's a even bigger jump in the number of folios. The new young earners came in, and the problem is that many young earners believed without any kind of proof that they had a high risk appetite. They themselves thought about that without any kind of proof, and they believed that over the long run, mid caps and small caps will outperform large caps. This is complete nonsense. There is really no data consistent enough to prove this. And yesterday we looked at 10-year returns, the SIP returns of small cap funds, and this table is again reproduced in today's article, except SBI small cap, which managed to produce 15% returns. And this was not a pure small cap fund for a long time. Only middle of 2018 it became a pure small cap fund. It had significant amount of mid caps before that. DSP small cap managed about 9%. The rest all 7, 6, 4, 3%, and so on is just terrible returns for a 10-year SIP. Now, the big problem with the small cap stock is it's extremely volatile, and the reason it's extremely volatile is because of the impact cost. If a fund manager or an institution tries to buy and sell large amounts of it, there will be a huge difference, mismatch between the buying price and the selling price, and this can lead to a loss, significant loss, and also volatility in the price. And the problem with the small cap is that it zooms up very fast, falls down as fast as it goes up, and then stays down for a long time. For example, the BSE small cap index took 9 years to reach its pre 2008 crash level. In 2008, it peaked just before the crash. To reach that peak level before the 2008 crash, it took another 9 years. And today, it's trading at 50% lower than what it was trading in January 2018. Nobody knows how long it will take to recover. It will take a long time, especially the small cap segment. It will take a long time to recover because if the economy, if there is a big recession or lack of consumption in the economy, the small caps will be the worst hit. They will simply not be able to recover quickly enough, and that's a big problem. Now, the reason why I say that at least a double digit return matters for small cap is again risk premium. I talked about it yesterday. I'm going to say the same thing again. You need to, when you're investing in equity and when you're taking so much higher risk than a large cap stock, you need to be compensated more, and that you must demand a higher risk premium. You can demand whatever you want, the market will give whatever it feels like, and there's no guarantee of that. So that's a big problem, and I will tell you why. The reason, look at the let's take a look at this time period. We are looking at 10-year SIP returns. That is, we are looking at an SIP started on 1st April 2010 to April 2020. Now let's break this up into two periods. That is 1st April 2010 to April 2015, the first 5-year periods, and then April 2015 to April 2020, the second 5-year period. So if you look at 5-year SIP returns for the first 5-year period and then for the second period, you'll see why it's a terrible idea to simply do an SIP in a small cap mutual fund. So from April 2010 to April 2015, look at that returns. These are SIP returns. 33%, 20%, 31%, 25%, 22%, 25%, 35%. Of course, quant small cap, it's not really a small cap. It was that's 10%. Forget that. That was actually some kind of debt fund in the past, I think. Forget that. DSP is 35. ABSL is 25. Everything stellar returns in this area. But then, if you look at the second 5-year period, all those returns vanished. Now, in the second 5-year period, -8%, 1%, -6%, -4%, 0.98, -8, -13, -6, -9, -12, -11, -13. Forget quant, that's fine. -8 DSP and -0.14 Aditya Birla. So all the returns that was there in the first 5-year period almost evaporated in the second 5 years. So if you look at the 10-year chunk, the returns are absolutely terrible. They're like SB return or even less than an FD return. It's just horrible. Please do not do a SIP in a small cap fund in the hope it will deliver in the long run. It will not. All these mutual fund sales guys, they missile everything and they will force you, especially bank relationship managers, they will force you to say, they will think in the long run everything will work. That's just garbage. Don't listen to them. Please don't do an SIP in small cap funds. If my suggestion is, and I've always held the view that investors should avoid small cap fund, good multi cap fund will have all the small cap exposure of mutual fund portfolio needs. If you want to invest in small cap, please don't do SIP. Buy from time to time. Buy when the NAV is low. Now is a good time to buy small cap funds, but keep an eye out. When the mutual funds close, when some mutual funds in the category close the fund for lump sum or completely all kind of subscription, when they close the fund for subscription, that's your time to pull out. That's when you should get out of it. Or you can use technical indicators. I have already made a video on this. I have a post on this. I will link it down. How to use technical indicators to buy and sell, go in and out of small cap funds. I have a tool, market valuation analyzing tool available. You can buy that. So please don't do a simple SIP. You will end up losing your money. You will end up losing your time in a small cap fund. Other things are different. In a small cap fund, just don't do an SIP. Time your entry and exit to a reasonable. I mean, just look at the market movements. If you don't want to do anything fancy, at the very least, that will at least help you get some gains instead of pathetic returns like this. So that's what I wanted to say in this video. Thank you. Bye bye.